this. So today we are going to cover the topic, understanding the role of annuities in retirement planning. We've had a few topics covered in these particular forums. Last time we covered on creating a personal financial plan, and Rose took us very well on the importance of personal financial plan, and we're able to see that roadmap in detail. And I'm glad for those who asked questions about the same topic. So also today, if you have any questions, just type them on the chat box. We'll have a few minutes at the end of this session to just go through your questions. So thank you very much for being here again. And Rose, please take over the session.
Good evening, everyone. I'm so glad that you could make it. You could join us today to talk about this very important topic of annuities. First, I want to apologize. Last month, we were not able to have a session. We had a family issue that happened around that time, and therefore I was not in a position to actually facilitate one. But I'm glad that today we can be able to do this. So today we'll be looking at annuities. It's one of the main products that are used in retirement planning. And therefore, we look at what is its role in retirement planning, and not just at the point of converting your savings into an income, but all the way right from the savings phase. So I'll be going through a presentation. I'll try and share it. Regina, if I can do that, let me see. And like Regina has said, please feel free to ask questions. I would expect people to have questions about this topic because many people, especially those who are saving through retirement benefit schemes, they definitely have heard about annuities. So if the screen share is okay, Regina, just let me know.
Yes, it's okay. We can see it well.
Okay. So for way of introduction, if it is your first time to join us, my name is Rose Wakiria. I'm a financial and retirement planner, and I'm also an author. I've written a book, Retirement Planning, and I hope you have read it. And if you haven't read it, later I'll be sharing details on how you can get one. And on a day-to-day basis, I work with individuals and families to help them make financial plans so that they can make the most out of their financial resources, and that way lead balanced lives, so that their lives is not just about looking for finances, but actually getting to enjoy their life. And I do this through a process where I help you to get to understand your financial behavior. We use psychometric tests to get to know what your financial behavior is or financial personality is. We look at your financial status, the current financial status, and then I work with you to help you set and clarify and prioritize your goals. And therefore, after that, we're able to create a plan and implement one that will help you to achieve your dreams. That is what I do on a daily basis, and I derive a lot of pleasure when I see somebody coming or joining me when they are not very clear about what they want to do, and at the end of the process, they have clarity on that. For more details, I'll also be sharing how you can reach us through our website and our contacts. So today we'll be looking at retirement because the topic is on the role of annuities in retirement planning. And first, I want us to go back to think about what will be those financial needs that you'll be having in retirement. If you have attended our previous webinars, remember I mentioned that one of the retirement planning things that we should be doing at every stage of our life is to define the retirement lifestyle that we want. Because once you determine the lifestyle that you want, then you'll be able to determine the cost of that lifestyle, and then you can start saving or invest to ensure that you're able to fund that lifestyle. So your lifestyle should not be determined by the money that you have, but you should first of all cast that vision. How do I want to live in retirement? And then you actually know how much you need and work towards that. If you have surplus resources, all the more better. So here's just some of the basics of a retirement lifestyle. You'll definitely need to take care of food. You'll have to eat throughout life. You'll have to have shelter. Hopefully everyone will have a home, a fully paid up home by the time they retire, because housing is one of the most expensive things that they take most of our income, even for those who are not even in retirement. So it would be good if you have that sorted out. Healthcare becomes significant expense in retirement. As you advance in age, there's the onset of old age diseases. And one of the other factors that you really need to care about is dependence. So we hope that our children will be financially independent by then, but sometimes they come back home, or sometimes they are struggling and you might need to chip in. So you have to factor that in. For most of us, we might still need to pay some house help or a gardener or somebody else to assist us with work. And that is a basic lifestyle, but some of us, we want to engage in hobbies that will cost us money. Some people want to play golf, some people want to travel, whatever it is that you want to do. And some people actually want to start business. That might as well require finances. But then what are the sources of retirement income? There are four main areas, sources of retirement income. The first one, and the smallest, especially in our context, is the Social Security. Here we are talking about government programs that help us to meet our needs. I'm talking about NSSF. If you have received your NSSF statement recently, and you can actually do that, my clients, I normally request them to get their pension statements, and they're surprised at how little money they have saved, even if they have been working for 20, 30 years. Get your statement today and find out how it is. So NSSF is one of the ways Social Security means, and NHIF in our context provides for medical expenses. So that is one way of meeting our retirement needs. The other one is working. Not everybody gets an opportunity to work. Not everybody is able to consistently work through retirement. And for majority of us, even if you have that opportunity, you might have to stop working because of your ability to work. So again, that's a temporary source of income. But one of the good ways that we can actually take care of our retirement needs is through investments and savings. So you invest during your working life, and then you're able to convert those into incomes. And probably you also have savings, or you'll be liquidating certain investments. That should form a part of your retirement income. And for majority of us who are in formal employment and saving through retirement benefits, that might be your main source of income. So these are the four sources, but what we realize is that there are risks associated with income in retirement and generally life in retirement. If you've read the retirement planning book, these risks, I've explained them in details, but today I'll just mention there are four types of risk. There's the financial risk, the public policy risk, the personal and family risks, and the healthcare risks. Financial risk, and these are the ones we tend to focus a lot on. Basically, we try to answer the question, will the income I'm getting in retirement be adequate for the rest of my retirement? So some people feel like the income might fluctuate depending on your source of income. If, for example, your source of income is investments, returns in the investment world will normally fluctuate. So that might lead to your income not being consistent. Will you be able to fund your lifestyle? And then, of course, there's the big issue of inflation. Right now, we are seeing inflation rates globally going up. People are printing money. I mean, there's a lot of inflation. There's a lot of money in the economy. The stimulus programs that governments have been doing have been pumping money into economy. So there's inflation. The general prices are going up. So 1,000 shillings, what you can buy with today, might not be the same thing it will be able to buy 5 years from now. So the question is, even if I start with a specific income on retirement, will I be able to fund that lifestyle 10 years, 15 years, 20 years down the road? Those are risks we have to take care of. Public policy relates to government's use of taxation and other tools to affect benefits. So recently, you might have heard that there was an attempt to start taxing retirees' money. Currently, once you're 65 years and above, and you're receiving your monthly income, your monthly pension, you're not paying tax after age 65. But last year, there was an attempt to actually start taxing that money. The positive thing that also happened last year is that because of COVID, those who accessed their retirement benefits last year, they paid less tax. So there's that impact of tax on our income. It could actually enhance benefits, diminish our benefits. And we also saw a revision of benefits with NHIF, and this keeps on coming from time to time. So that is something we have to work with. Things can get better or things can get worse. When it comes to personal risks that we must manage, there could be death of a spouse, and this spouse could be the main income earner. Probably you are relying on their pension. or probably their pension is making a big contribution in terms of household spending. So when that happens, what happens? Again, death of a spouse also leads to what you call loneliness and isolation for those people who might have to start living alone. What does that mean in terms of your ability to fund your lifestyle in retirement? For dependents, like I mentioned, you might get additional dependents. Some people have aging parents, so you at some point probably forced to start chipping into their expenses, or your own children could come back. Sometimes they come back after they've left home. Sometimes they don't just come back alone, they come with another generation. And so you're probably supporting 2-3 generations. How can you manage your retirement income to ensure that you're able to take care of those things? And the one thing that is likely to affect all of us is what you call longevity, the uncertainty of your lifespan. You don't know how long you're going to live. You could live for a short period, or you could live for a very, very long period. Globally, people are living longer because of advancement in medical technology. Diseases are being treated, diagnosed early. So you should also work with a long life. And I keep mentioning in this forum that when insurance companies are calculating your annuity, they normally assume you're going to live to age 85. So you can as well use that as a benchmark. Will your benefits or will your savings or income be able to last you that long? And of course, the healthcare, we all understand how expensive healthcare is in this country. And we encourage people to get insurance, and especially even in old age. And at that time, premiums are high. And we know that insurance does not cover everything. It also has cover limits and sub-limits. So there might also be some out-of-pocket expenses. So when we are talking about the income that you're going to use to fund your lifestyle, we have to factor in all this. So this calls for a diversified source of income. One income might not work, because if you're purely relying on retirement benefits, then public policy could affect those benefits. They could introduce more taxation or withdraw certain taxation. It could increase or reduce your income. And the fact that your spouse might pass away, then what does that mean to your lifestyle? So we'll be looking at how annuity can help us to actually manage these risks. So in retirement, I don't know if you have noticed this, there's some people who talk to me and they tell me their parents now require support. They're in retirement, but their income is not sufficient to provide for their needs. We call that the income gap in retirement. So you have basic expenditures that you need to maintain a certain lifestyle that you have picked for yourself. And it may not even be an extravagant lifestyle, but you need food, you need, like we said, you need shelter, you need medical expenses, you need to pay your workers, even if that's all that you're doing. But the other question is, what is your guaranteed income? What is that income that can ensure that you meet your basic expenditure? Now, the scenario we are seeing, especially with our parents, some parents, is that we are being forced to chip in into their lifestyle or to fund their lifestyle, but these parents or this generation, they have assets. So ultimately, when they pass away, they are going to give us pieces of land, they are going to give us assets. And the question is, do we really want the inheritance, or we would rather than they take care of their needs today? So that is the challenge that many people are struggling with the parents, and probably even for us who are approaching retirement, we might struggle with that. So what you need to look at, and basically what I've been talking about, is look at your income sources, and then look at the expenses that you might actually have to incur. And this is just an example. And then you find out, will you have a positive income gap or a negative income gap? If your income is more than your living expenses, then you're doing well. But if your expenses are more than your income, then that means that you'll not be able to fund that lifestyle, but you will need assistance. So for example, this person has an income of 100,000. They're giving 12,000, they're paying taxes 7,000. So the spendable income is 81,000, but their expenses are 96,000. So if this is your parents, they'll probably be calling you at some point during the month and asking you for some money because they need to meet that gap of 15,000. And we look at what we need to do about this as we progress. But this is a challenge that we are all going through because of what we have learned about wealth accumulation. According to Professor Jeffrey Brown, he's a professor at University of Illinois, he caught it in the best way possible. I could not find words that can describe the challenge we find ourselves in. And I read this because this is quoted as he said it. Majority of retirement planning or even financial planning advice that individuals receive usually in the course of their lifetime, focuses on issues related to accumulating wealth, such as how much to save, how to allocate your portfolio across different assets, the advantages of using tax-deferred accounts, and so on. The usual things we talk about in these webinars. Such advice is important because without it, without wealth accumulation, then most individuals will not be able to sustain their living standards after they exit labor force. But the downside of this emphasis on wealth accumulation is that many customers have a difficult time transitioning from a mindset of I need to grow my portfolio to the mindset of I need to convert my wealth to a stream of income. So we keep focusing on growing our money, but we are not thinking about converting that income, those assets into an income. Of course, providing income is often the primary point of saving for retirement in the first place. When you're talking of retirement planning, it's because you want to have an income to fund your expenses. But many retirees do not begin to think about the income aspect of their efforts until they reach retirement age. And I think even in our Kenyan context, it even goes beyond the retirement age. We have people who are still holding a lot of assets, like in land. Well, we very well know that land, unproductive land, which is not giving you, you're not leasing it out to give you some money, or you've not developed it. We know while it is still there, it is not helping you in any way. Until you convert it into an income, that's when it can help you to meet your living expenses. So we find people still holding on to that and even going ahead to buy more. So they're still in that mentality of accumulating wealth, and yet they're already in retirement. And so this creates that challenge where now you still have more, you have a big income gap, and you start now wondering, how do you meet your lifestyle? You're struggling to meet your health bills. You're asking your children to fund your lifestyle. And this is one of the things that we need to ask ourselves. How can we accumulate wealth, but even in assets that enable us to actually have that income when we need it? And an annuity is one of those things that can be used. Have you ever thought of using annuities as a wealth accumulation tool? It has its own unique aspects, which we look at, which to some people, they may not look as attractive. But I would just want to share just a quotation I did for one of my clients, just to demonstrate how you can use an annuity to accumulate wealth. So this is a client who came to me, and she did not have retirement savings, and she was feeling she's late for retirement planning, and therefore we were looking for an asset that we can use to accumulate retirement savings. And after evaluating the assets that we had, we realized that this was the best approach. So she put in 4 million shillings. And by the time she retires, 15 years from now, that 4 million shillings will have accumulated to 19 million. Now, if you are not in business, or I don't know what else, which other investment do you think would be able to grow that money to 19 million? And we are talking about a guaranteed investment. Because when you do this, an insurance company will quote for you, they will give you a contract, and they'll tell you, come 15 years from now, you'll start receiving this amount of money. So this is just to demonstrate that this 4 million will have grown more than 4 times and become 19 million. So annuities can actually be used to accumulate wealth. Just like you buy a piece of land today and hope that it is going to grow. The value of that land is going to grow in a few years' time. That's the same thing with annuities. And what enables it to grow is the fact that that money remains inaccessible. And therefore, insurance companies are able to invest their funds into long-term investments, which tend to have better returns. And they're also able to invest them in secure assets such as treasury bonds, and they're able to guarantee a very, very good return. So that is one of the ways we use annuities to accumulate savings, to grow your money from 4 million to 19 million in 15 years. The other way we use an annuity is actually to diversify your investments. Many people put a lot of money in land, or some people also find them have a tendency of buying more and more insurance policies. It's okay to have different assets, but have you considered that you can actually diversify your wealth by buying an annuity? And this annuity, you'll be buying it to meet a need in future, because annuities, the way they work is that you put in the money and then they convert that money into an income, either immediately or at a later date. The other way you can use an annuity is actually to protect your spouse. If your household heavily relies on your income, then it means in event of a premature death, in event of your early death, then your spouse would be exposed. So when you take an annuity and you take it as a joint life, you take it on your own life and that of your spouse, what happens is that when the annuity starts making payments, it normally pays to the last survivor, whichever spouse lives the longest. So if you are the one who bought it and you die, then it will continue paying that income to your spouse until their death as well. So you take care of your spouse both now and even in future. And how the annuities work is that you bring in a lump sum, a huge amount of money. You don't put in 10,000 like that. You come with a minimum. Some companies will require a minimum of like 500,000, 600,000. And after either immediately or later, that money is converted into a stream of income, either for the rest of your life or for a specified period of time. And the other advantage of using annuities is that they defer taxes, especially from your pension savings. So if, for example, you're in a provident scheme is a type of scheme, retirement benefit scheme, that allows you to access all your savings as a lump sum. If you access your savings as a lump sum, the maximum you can access tax-free is only 600,000. The rest has to be subjected to tax. And some people pay a lot of money in taxes. But when you put your money in an annuity, what it does is that it defers tax. You don't pay that tax upfront, but you pay it on a monthly basis. So, and you only pay on the portion of money that you access. So if you access 50,000, you'll only pay tax on what is payable on 50,000. And then once you reach age 65, you actually stop paying taxes. So ultimately you avoid paying taxes. And for those who don't need the pension income immediately, you can actually make a choice. You can buy an annuity, but you defer it until you're age 65. And then you start accessing money when you're 65 and you're not paying any tax. So this makes annuity a very unique product. Very, very few investment products will actually be help you with taxes. Most of them, you actually work with money you've already paid tax on. But for annuities, you can actually defer your taxes. I hope we are all together. So sometimes we find annuities are complicated. I just want to simplify them. They are very, very simple products. And we look at 4 main aspects of how they work. First, it's important to note that an annuity is an insurance product. So this will only be provided by an insurance company. In our context, it can only be provided by an insurance company. In Kenya, we have about 18 life insurance companies. I don't think all of them offer them, but majority of them will offer annuity as a product. And then the other aspect of them you need to know is that, especially in our local context, the annuities that we have, you have to bring in a lump sum. So you have to accumulate this money either from your savings, from your investments, or from your retirement benefits. You bring in a lump sum. And then once you take an annuity, it gives you an income for the rest of your life. So we don't know how long you're going to live. So you might live a short time, or you might live very, very many years. It will pay until death. And what happens is that after some time, insurance companies will require that you provide proof of life, that you are alive. So after probably 6 months, they send you a form. You need to sign it and send it back. That proves that you're still alive. When they don't get that form back, they assume you're no longer alive and they stop the payments. Then another way of accessing the income is for a specified period. We call those type of annuities, annuity setting. So you can take an annuity, and this is one of the ways, even when we want to talk about other things you actually use an annuity for. You can use it, for example, for education policies, where you actually buy an annuity, probably to take care of your children university education. So you defer it for a number of years, and then when you want to start accessing money, you decide, I'll access it for the next 5 years. So every year you can actually get an amount that will take care of your school fees. We call them annuity certain. They pay an income for a specified period. And then when it comes to accessing money, once you put money with an insurance company, you can either start getting money immediately, that is either within the same month or the following month, or you can defer to a future date. That you say, I'm putting in this money, but I don't need it for the next 5 years or for the next 10 years. So I want to start accessing it for 10 years. So this gives you an indication of how you can use annuities for other goals. And it can also help you to have multiple annuity products to take care of different needs, even in retirement. But the interesting about annuities is that they are very fixed contracts. You cannot modify anything about it. For example, if you put $1 million, you cannot add any money into that policy. The amount you put remains as the amount insured, or the amount that they're working with. You cannot access that money as long as you're alive, but in event of death, it can be paid out. And you cannot change any aspect of it. So when you're getting into annuities, also it's very, very important to be very clear of what you need, your income needs, and ensure that these are funds that you have earmarked for retirement, for example, or for a specific purpose, and you will not need them. So that is a unique aspect of annuity. You cannot change anything. If you have more money, it means you'd have to buy another policy. But the interesting thing about, because this is a question that normally comes, so what happens if I buy an annuity today and I pass on tomorrow? Do I lose all my funds? Annuities come with what we call a guarantee period. You choose a guarantee period, and this guarantee period is a number of years that payments must be made, either to you, if you're still alive, and in event of your early death, they are paid to your next of kin. Now, some people choose zero guarantee. They are like, I'm the only one who needs this money. If I die tomorrow, no more payment. There are very few contracts with that zero guarantee. You can choose 5 years or anything between 5 and 20 years. I think in the market, the annuities that I've worked with, the longest guarantee is 20 years. That means even if you died 1 month after receiving only one annuity payment, if you had picked 15-year guarantee, they would continue paying to the next of kin for the next 15 years, or some contracts can convert that into a lump sum, and then the money is paid to the next beneficiary. So how do you use this guarantee period to your advantage? So you need to look at your circumstances and see in your family, are there people who need this income if you're not there? For instance, if you have a spouse, then you need to choose a guarantee period to ensure that they're also taken care of, especially if you had not taken a joint life. If you have children, young children, dependent children who would need this income in event of your death, you can try to pick a guarantee period that would ensure that their basic income needs would also be covered if you're not there. So, but on average, we encourage people to take not less than 10-year guarantee. Around 10-year guarantee, you'll probably have used most of your money. If you take less than 10-year guarantee, probably in the event of an early death, the insurance company is the one that will benefit the most. Of course, if you survive the guarantee period, the annuity will continue paying until death. So in summary, we can summarize annuities with these features. In terms of income, you can start receiving the income immediately, or you can defer for a number of periods and then you start receiving the income in future. In terms of amount, you can actually take a fixed amount. You can say, I'll be receiving 20,000 from now until my death. That is a fixed amount. Or you can say, I want to start receiving a lower amount now, but to take care of inflation, then I want that amount to be growing either by 3% or 5% every year, year on year. And so I'll start low, but as the years go along, I'll be getting more and more income. And again, you can either take this as a single life, just on your own life, so that in event of your death, the payment will cease, or if the guarantee period is still outstanding, then the money would be paid to your beneficiaries, or you can take it as a joint life with your spouse. You can't take it with your sister or with your brother or with your children. You have to take it with your spouse. these are some of the features of annuities. That is how they work. Now, when do you use deferred annuity? The quotation I showed there earlier was of a deferred annuity, which was able to grow your income from, or your savings from 4 million to 19 million in 15 years. First, for those who are late in planning their retirement, they've realized that they've not been saving enough and they want to accelerate. This is one of the best ways of accelerating, because the money will be locked, the money will be fixed, it will be given time to grow, and you have earmarked it for retirement. It's a very good tool to play catch up. And for those who, for example, you have your own individual retirement plans and you have maxed on tax-free contributions. Tax-free contributions are the contributions you make and you don't pay tax on them. The current limit is 20,000 per person per month, of course, depending on your salary. But again, if you're in an employer scheme, that limit is shared by you and your employer as well. So if you feel that you want to make additional voluntary contributions and they are over and above the 20,000, even if you put that money in a retirement benefit scheme, you normally don't get a very good return on that money, because that income, I mean, that saving come from taxed money already. And then the income that is earned on an annual basis, for example, if the pension scheme declares a rate of 10%, you have to pay 30% interest on that interest. I mean, 30% tax on the interest on an annual basis. So that effectively means your savings are growing 7%. So now, that means that your savings, we call them the non-tax allowable or the unregistered benefits. It means that they are growing at a much lower rate than the registered benefits, and even sometimes at a much lower rate than even what a money market would do. But so the best thing would be accumulate that amount to a minimum of a deferred annuity, and then go buy a deferred annuity, and you'll be able to enjoy a much, much better return. So for those people who earn more and they would want to save more, this is one of the products that you can use. For those who earn irregular incomes, or people in business where they don't earn an income every month, and probably when they earn the income, they get a lot of money, then this would also be one of the best places or best products to put your money, because you'll have the lump sums and you have earmarked this money is for retirement, then you're able to actually put it away. One of the other ways that you can use this is a number of people access their retirement benefits when they change jobs. And later they realize, oh, I shouldn't have received this money because it was meant for retirement, and I'll probably divert it to something else or use it up. So taking it back to a pension scheme, you'll be taking that money back as unregistered benefits. So what that means is that, again, you'll be earning 70% of the declared rate. So that might not be the best place to put the money. A deferred annuity would be one of the best places, because that money is earmarked for retirement. You can defer it until retirement. And of course, when you access lump sums, for people in business, you get profits, or people in employment, probably you get a very good bonus. I always say every income you receive affects your lifestyle today. It should also affect your lifestyle in retirement. So choose to pick part of that money and put it in a retirement plan. And in that case, a deferred annuity would actually do very well. If you are retiring and you want to use an annuity to provide you with an income, but you realize that you don't need an income in the next 5 years, maybe you are still working or you have other sources of income, you can actually buy a deferred annuity to provide you with income, but defer for a number of years until when you think you'll want to access your income. Or the other way is to ensure you can also defer until you're age 65, and then you start receiving your income without paying any tax. So a deferred annuity is one of the products that is not used in this market, either because of lack of knowledge, but it's one of the products that can actually help you a lot with retirement planning. That is saving towards your retirement, but also when you want to access your retirement savings as an income. And when you want to access your retirement income immediately, we normally call that an immediate annuity. So if you think this is a product you'd be interested in, please get in touch with us and we'll help you to find out where you can get one from. So we'll continue and ask ourselves what happens in event of death when you're using an annuity. This is both forms of annuities, whether it's immediate annuity or deferred annuity. So when you're taking an annuity, you have to nominate beneficiaries. These are people who would access your benefits in event of your death. Now, life insurances and retirement benefits, which include annuities and pension schemes, are the only two kind of products or the kind of financial instruments where you don't have to go through the administration succession process to access benefits from a deceased person. So it's important that you nominate the people who would need that money. Because if you don't nominate, for example, your immediate family, your children who need school fees, who need upkeep, then they would have to wait for the other process, which takes time, about 6 months, for them to get letters of administration before they can access your other assets. So nominate your beneficiaries carefully. And then depending on the company you're working with for the immediate annuity, that is the pension where you're converting your savings into an income immediately. Then some will normally, on your death, on the death of the person who has taken the annuity, some will pay off the beneficiaries a lump sum, and most of them also normally pay an income. So you can choose which option you want as you choose the provider. So these benefits are only payable in event of death. You cannot change the contract, you cannot access the money, but even for the deferred annuity before the income starts, in event of death, then the amount would be payable to beneficiaries. So it's important to know that it's your beneficiaries who will receive the money in event of your death. You cannot access that money while you are still alive unless it's an immediate annuity that has already started paying and you're receiving the income. So your money does not get lost. The only exemption would be if death occurred after you have after the guaranteed period. So let's say you had chosen a guarantee period of 10 years and then death occurs on the 12th year, then at that moment, in event of your death, the payment would cease. But if death occurs, for example, on the 8th year, then the insurance company would pay to your beneficiaries what was due for 2 years, either as a lump sum or as an income. I hope that one is clear. So you don't lose your money during the guarantee period. After the guarantee period, the payment will cease. Now, you might ask yourself, investing in an annuity, is it a safe option? Annuities are some of the safest investments in the sense that they form part of what we call life fund with insurance companies. A life fund and retirement benefits fund as well are normally segregated or separate from a company's asset. So for example, if RSI was an insurance company, Retirement Solution was an insurance company, and they decided to do annuity business, Retirement Solution will have its own company assets, but they create a separate fund called the life annuity or the life fund or the annuity or the pension fund, which is a legal entity in itself, separate from Retirement Solutions, and they actually invest the money in the name of that fund. So even if Retirement Solution became insolvent, it cannot continue in business, what would happen is that that life fund remains and it can actually be sold to another company. I believe many of us who are here were there during the times of Kenya National Assurance. They had those kind of businesses. They had life insurances, they had pension, they had annuities. Those funds were sold to other companies and they continued paying. And some people are still getting their payment from those funds. So it's one of those investments that are separate from the founding company or the parent company, and they are closely regulated. IRA, Insurance Regulatory Authority, closely monitors those funds, and even for retirement benefits, they work the same way. However, it's also important that when you're choosing a provider, you look for strong, reputable companies. Sometimes it might not be an issue of inability to pay, but it might be an issue of bad service or poor service, or maybe even delay in payment. So you want to work with a company that is strong, that is reputable, that has a good credit rating, and a company you can also easily get information about. So do the best due diligence you can to partner with a good company. so that you are able to have a smooth sailing. But the interesting thing I found about my annuity clients last year, when COVID hit, none of them called me to find out about what will happen to their money, because their money was just hitting their account on the right date. The alternative to an annuity is usually an income drawdown. Some of my clients called me and they were like, okay, Rose, do you think our projections will still work? Because for income drawdown, the arrangement is different. It's not a guaranteed income. It depends on the performance. So with annuities, yes, there are some of the low risk investments. And even when it comes to how insurance companies invest that money, because these are long-term commitments, they also tend to invest them in treasury bonds. And that's where they're able to give good returns. And also the fact that treasury bonds will give regular income, they're also able to pay the members' income on time. So it's one of the safest investments. So how do you buy an annuity if you have chosen to buy an annuity? One of the things you need to do is to assess your current and future income needs. Now, when you do that, you look at what we call the basic expenditure, like we talked at the outset. My recommendation to my clients is usually since an annuity is a guaranteed income, it will pay you an income until death. If you take a pension annuity, please cover your basic expenses with an annuity. That will ensure that you will not lack food, you'll take care of your shelter, you'll be able to take care of your health expenses. For example, if you are on regular medication, you have factored that into your monthly budget. So this will ensure that you remain financially independent and hopefully you won't be a burden to somebody else. So try to cover your basic expenses using an annuity, because it means you can rest easy, that is covered for life. And then for other discretionary or additional expenses, the hobbies, the businesses you'd like to start, or the travel you'd want to make, then you can use investment income, which can fluctuate depending on performances. Like I mentioned, you can only purchase an annuity from an insurance company. So there are about 18 life insurance companies, and probably not all of them are providing annuities, but the bulk of them are. So you can request for a quotation from any of those companies. So I would encourage you, especially if you're in your 50s and above, and you're considering using an annuity for your retirement income, just write to any insurance company and request them for a quotation, compare with different companies, get to know how much your savings can actually afford you in terms of a lifetime income. You have to keep on asking quotations, because quotations are normally valid for a short period of time. Some companies 30 days, some companies 60 days. And this is because it depends on where the companies are investing the money. So if they have a good investment opportunity, they are sometimes able to give you better rates. If they don't have a very good investment opportunity, they have to adjust that so that because they're making a commitment for life, that they'll be able to pay your income. Then you'll need to fill an application form from that particular provider that you have picked, and then you transfer the lump sum. And like I said, this could be your personal savings, this could be from your retirement savings, or it could even be a combination of the two. So you don't just have to say, I can only put in the money from my pension scheme. No, if you have additional savings, you can actually put them in, buy the same annuity, or even buy multiple annuities. If you have multiple annuities, it's important to factor in the taxation. So it's very important that you let the providers know the source of this fund so that they're able to take care of taxes. Now, we've talked about the good side of annuities, but is this good for everyone? Annuities are good for people who need to have their basic expenses covered. That is, you don't have all the income that you need, and you really need to ensure that you can cover your basics. But for people who have adequate and diversified guaranteed incomes, it might be an option, probably not necessarily what you need. We are talking about people who actually don't need, for example, their retirement savings in retirement. Those are the people who would consider that. For those who have ill health, who are very unwell, and probably they will require a lot of medical care, medical expenses, and probably they're in a provident fund, then they might consider not using an annuity because the capital is tied and there's no way you can access it. But again, you need to be very, very careful, because some people, again, who have ill health, this might be the right product for them, because it will ensure that they have that guaranteed income to take care of their medical expenses. For example, their usual regular drugs that they take. Now, there's some people probably who, I don't know, prophetically or for whatever reason, they know they're not going to live long. And I've put an asterisk there because no one knows their date of death. But yeah, if your quality of life is so bad, chances are you're not going to live long, then probably you might have other options that would enable you to enjoy your money for the short life that you have. But again, remember, we don't know how long you're going to live. And also for people who have high expenses and probably high irregular expenses, and monthly income might not be suitable for them, then probably an annuity might not work for them. I'm talking about probably somebody who is retiring and they still have huge school fees to take care of. Then when you spread the income in terms of an annuity, it might give you a consistent low amount that might not be able to ensure you educate your children. Then probably a product like an income drawdown that allows you to draw different amounts of money per year might be better off, but it depends on several things. And of course, for people who want to leave an inheritance, you want to use part of your retirement savings to pass on to the next generation. With an annuity, you'll not be able to do that well, especially if you want to leave lump sums. Then an annuity might not be the best for you. But what I like saying, especially if you know that you don't have all the resources or your incomes are not diversified enough to take care of your basic expenses, then I suggest that you seriously consider an annuity. Then you might ask yourself, is annuities the only way I can get guaranteed income? Definitely not. There are other sources of income that give us income on a regular basis. And many of us choose to go the rental income way. We understand property, we invest in property, we put up houses, and we get an income from them. Or you can even choose to go the bonds way, where you buy a government bond or a corporate bond, and then they guarantee you an income on a specific date, and you can write a check to go to the bank because the treasury bond, the interest will be there on that specific day. But there are a few nuances about these two types of incomes that make them, even if they could be guaranteed to a certain extent, they are not as good as an annuity. Let's look at rental income first. First, we can't call rental income guaranteed income. It is regular income in the sense that it can come on a monthly basis or on frequently or whatever frequency you use. But there's no way, it's very hard for you to guarantee rental income unless you have a very long-term lease, because your income depends on occupancy levels. Do you have a tenant that month? If you don't have a tenant, then your income fluctuates. If you don't have maybe you have many units and all of them don't have tenants, then you actually have no income. And then in addition to that, for you to be able to maintain that regular income, you also have to ensure that you maintain the property. So sometimes you might need to spend more to maintain the property, or you might need to do a lot of renovations to ensure that you continue getting good rates. So rental income, in as much as it comes every month, might not be guaranteed. And some months you might suffer, or in some situations you might not be able to meet your needs. Bonds, on the other side, they give you guaranteed income, but bonds have a period. So you buy a 10-year bond, a 15-year bond, 30-year bond, whatever period. So if you outlive that period, it means that the coupons will stop, you'll get your lump sum, and yes, it might continue. You might decide to use the lump sum. That one cannot be guaranteed. We don't know how long you're going to live. But the other thing, you could even decide to reinvest it. But with bonds, there's what you call the reinvestment risk. You're not sure that you'll be able to get the same rate of return you enjoyed before. So you could get a higher actually, or even a lower return. So bonds will give you guaranteed income for the duration of that bond. And then also the other aspect is that they're marketable securities. You can easily convert them into cash, and therefore you might compromise your retirement needs later in life, especially if you feel that let me liquidate this because I can. So they are different. and the best thing would be to have a strategy that incorporates all of them so that you are able to get the most of everything. So have an annuity. If you are interested in property, you can have rental properties. If you're not interested, you don't have to do them, but also have some bonds that would also supplement that income and ensure that you have a guaranteed income. We are almost winding. So everything I've talked about, you can actually find it on the retirement planning book. Most of what we've done is you can read a lot on chapter 8, especially if you're seriously considering about getting an annuity, how to identify a provider, what type of annuity is good for you. The retirement planning book will give you more details on that. And you can also reach out to us through our website. So if you need help with annuities, either to plan or to save for retirement, to grow your funds, to accelerate your retirement funds, or you're just about to retire and you want to convert your savings into an annuity, please reach out. Some of the things we help you with is to help you determine or define the retirement lifestyle that you want. And then we assess what will be the cost of that lifestyle. And then we come up with figures that we can work with. And then we ensure that we are taking care of the basics and the discretionary, the good to have expenditures. And then we determine what is the right purchase amount. Of course, for those who are coming from pension scheme, the minimum is already defined because it is 2/3 of your accumulated savings. But sometimes you might need to actually put in more. And then we also help you get an annuity, but we also look at other investments that you have. So we ensure that you're also having diversified investments that will ensure that you're able to meet your goals. So that should one area not work so well, then you're covered in another area. So we normally do that. It can be a short consultation where you just want to convert your savings into an annuity, or you might want to do a comprehensive retirement planning. And we actually do this through a 6 weeks process where we help you cast a vision for your retirement in a holistic lifestyle. We look at a holistic lifestyle. It's not just financial. It's also about how you relate with other people and also what you will be doing during retirement. So in those 6 weeks, we meet once per week for 2 hours. And what we do in the first meeting, we get to know each other. I get to ask you a lot of questions to get to know you so that I'll use that information as we progress with the process. The second meeting, we analyze your financial situation. So I want to know what are your kind of incomes, what are your debts, if you have any, what are your assets. And then on the third meeting, we set, clarify, and prioritize your goals for whether it's before retirement or for those who are transitioning in retirement. And then on the fourth meeting, I give you my recommendation, which is basically the investment strategy. How do you place your money? How do you invest your money to ensure that you meet the goals that you have specified? And then I take you through a decision-making process that can help you make financial decisions because you'll continue making financial decisions throughout life. And then the last meeting, there's always an issue that needs more time, more attention, and we look at them. Some of them will be non-financial aspects. Some people are thinking about passing wealth to the next generation. Some people are thinking about what will I do with my time in retirement. That is what we do. The price for that 6 weeks process has been $45,000, and that price will continue until end of this year, but from next year it will go up to $55,000. So if you'd want to take advantage of the lower price now, you can actually sign up as soon as you can. If not, you can plan to join in next year. I would also encourage you to consider gifting a friend the retirement planning book. If you have read it and you felt that it was a good value, please consider giving it a gift. If you're struggling, what am I going to give somebody for Christmas? If you think your parents need this information, please get the book, read it, and go and read with them. It's a book you can read within a weekend. So when you go for Christmas, you can read it with them and you can help them through that. Or if you know a friend who's approaching an age when they seriously need to consider retirement, and it's not a specific age. Everyone needs to plan for their retirement, and the sooner you start, the better. So you can get that book in various stores. You can get a Kindle version if you like reading online, or you can get it from any of these bookshops. And you can also get it directly from me if you want to get a signed copy. So Get in touch with us if you feel that you need help or assistance, or if you just want to have a conversation regarding retirement. So that brings me to the end of my presentation. I'm ready to take the questions, and thank you for staying in. Back to you, Regina.
Thank you. Thank you very much, Rose. I'm glad to have learned about annuities. I recall articulating the concept in my accounting class, but I didn't know it's something that can really apply to me personally. So this evening, I'm glad to have the knowledge on how it can apply to me as an individual. So you have a few questions that I'll just bring them up to you. There's an example that you gave us as part of your presentation for one of your clients, and the annuity was maturing to 19 million. So I guess I want to know how much will the annuity translate on a monthly basis?
Okay, if I can recall clearly, this is a lady client who will be 65 years old when she starts accessing money. So we have to assume using today's rates, but we don't know what rates will be applicable in 15 years time. But the quotation we had, she was going to receive 190,000 shillings per month. So current rates, they normally work around 1% of the value as your monthly income, roughly around 1% of the value.
Okay, thank you. There's one testimonial from Tabitha. She says that if I got a gratuity from my contract and I bought an annuity, will I avoid the 30% tax?
Yes, because not really. You can transfer your gratuity to a registered pension scheme, and you'd be able to transfer 240,000 for every year, I think for a maximum of 5 years, tax-free, but anything over and above that would be taxed. Now, if you choose to transfer it to a deferred annuity, then in this case, you'd have to access the money. That means you'd have to pay tax. And then once you access the money, then you'd put it in the deferred annuity. But for me, what I would recommend is you put what is allowed to be taken as tax-free into a pension plan. So the 240,000 for every year for 5 years, maximum of, that comes to about 1.2. You put that in a pension plan, and then you access the balance, because either way you'd still have to pay tax on the balance, and then that one you can put in a deferred annuity. So with retirement planning, what we do is that we look at where you are or the resources that you have, and we look at how we make the best out of them. So it might mean a combination of retirement planning tools. You might need to use a pension plan and an annuity at the same time. But for any money you have that you have already paid tax on, then a deferred annuity might give you the best returns.
Okay, thank you. A few more questions. This one comes from Jane Rose, who's a good friend to the company and the institution that Rose runs. She says, thank you for the great insights. Please give us an example of, say, if I bought an annuity for 5 million, what will I get monthly and what tax will I pay?
Okay. Now, that depends a lot on many factors. When you are taking an annuity, we actually request for a quotation for every single case. We send a quotation to insurance companies, and what they require is the gender. If you are a lady, you receive less money compared to a man, same age, same amount of money, because women are expected to live longer. It will also depend on your age. If you're 50 years, you're 55 years, the older you are, the more the amount that you take. The other thing is, if you take a joint life and you're taking it with your spouse, that will also affect the amount of money that you receive. And finally, it also depends with the guarantee period that you take. If you're taking a shorter guarantee period, the income will be higher compared to if you're taking a longer guarantee period. And one other thing also, if you're taking a fixed amount, that will also be different compared to if you want your amount to start low and continue increasing. So what I'll do, probably as we take another question, I will look for a quotation I did recently for a client, and we look at their specific details, and then I'll be able to project it. and then we'll see. So it might, we'll have to work with what we have. So the person might be 50 years, a male, this kind of amount of money, and then we'll share. So I will look for a quotation and then I will project that.
Okay, thank you. As you look for that quotation, there is a clarification from Mary. She's asking, are all annuity payments monthly? And she also comments that I like that it can be used as a source of income. Then maybe you can answer with one more from Penina, who's asking, can one purchase an annuity in your 30s and enjoy the benefits upon attaining retirement age?
Let me start with the second question. If you are 30 and you want to buy an annuity and you want to enjoy your benefits when you're 60 or 50, that is an example of a deferred annuity. So you put in the lump sum, you'll defer access to money until when you're 60. That's a deferred annuity, and it will grow exponentially. I did a quotation for a lady. She actually took the policy who has 800,000. She had accessed her money from a retirement benefit scheme. Then she realized then she should put it back. So she had 800,000. She has deferred it for 25 years. By then it will be over 10 million. So the money will grow over 10 times. The other question, I think I have forgotten. Regina, if you may remind me, the first question.
Are all annuity payments monthly?
No, you can actually choose a frequency of monthly, quarterly, every 6 months, or even annually. The reason why I'm emphasizing monthly income is because recently there was a change of regulation. Remember the public policy risks? They changed that you only get the tax benefits where you stop paying tax at age 65 only if you're receiving your money monthly. So for you to get the tax benefit, you need to access your money on a monthly basis. But if that does not matter to you, or the amount you put in the annuity was already taxed, so you would not be paying tax, then you can choose whatever frequency you want, quarterly, half yearly, or even annually. Was there another question to that?
No, that's it for now. In fact, I ran beyond our time. If there's another question, please just type on the chat box or raise your hand and I'll allow you to just ask your question. There's a compliment from Violin. She's saying that the book is truly a perfect gift. So for those with the book, just to refresh your knowledge, go back to chapter 8 and read more on annuities. We'll also share this recording on YouTube so you can watch for those who joined us a bit late. So Rose, if you have that example, you can give it to us, then we can close the meeting today.
Okay, please give me a minute. I look for the quotation.
Okay, as you look for it, I'll just emphasize that for those who might want to get in touch with Rose, I've just shared her number and email on the chat box. So feel free to call her, text her, or send her an email. Again, you can sit down with her for a free consultation for 30 minutes only. So just to go through what your requirements might be, because these are unique to everyone. And also for the 6-week session, feel free to take advantage of that rate, which might change in the coming months, that is next year.
Okay, so let me try project this. So I'll project an analysis. I'll try to hide the, I'm hiding the insurance companies. You can see it well.
It's quite small. If you can just zoom in your screen.
Okay. Please let me know when it gets better.
That's much better. That's okay.
Okay. So just a minute. So this is a 55-year-old gentleman who has 15 million. So this is one company. The first figures here, it is one company, and this is another company. Like I said, we quote from different companies and then we pick, we choose the right provider. So the purchase price is 15 million. Now, the breakdown of taxes depends on your savings. Some people have a lot of money that was tax-free, so they'll need to pay taxes. And some people have a lot of money that is unregistered. But I'll also try to show, assuming all this was tax-free and they had to pay tax, how much they would pay. So 15 million at 55 years, if he takes a 10-year guarantee, he will get, based only on his life, he'll be receiving an amount of 147,000. This is gross. If he takes a joint life, that is on his life and on his wife's life, in event of his life, the wife would get 50% of the income. So the income he will be receiving is 135,000, but on his death, the wife will get 50% of that amount for the rest of her life. The other alternative is where he takes a joint life with his wife, and on his death, the wife will continue receiving the same amount that he was receiving. In that case, he will be receiving 129,000. So this is the other mistake I keep seeing with a lot of clients, where many clients will choose to go for 147, which is higher definitely than 129. And you see the difference is very small, but what it means that if this gentleman dies after 10 years, then that amount will cease. But if he dies after 10 years, the wife, if he took a 50%, we call it reversionary. That is what the amount would revert on his death. Then the wife will continue receiving half of 135. And if you want the spouse to continue receiving the same amount in event of your death, then you take 129. As you can notice, as the guarantee period increases, the amount that is payable reduces. This is because this is a commitment. The insurance company has to pay this amount. So it reduces that because it can already foresee the risk that it has to take care of. So this is one company. You notice the 10-year guarantee is lower, but another company, a 10-year guarantee is higher. No, the entire quotation is higher. So this company is giving a slightly lower deal compared to the other company. So we normally get quotations for 4 or 5 companies among the reputable companies, and then an individual gets to choose. So let's assume my client chose this income, which I do not encourage. I encourage those who have spouses who would need the support, encourage them to take joint lives. So we are going to try to start to compute how much tax they would pay. So there's usually a tax-free amount of 25,000 given to every retiree. And we said for annuities, you need to be receiving that money on a monthly basis, or rather even income drawdown, as we'll come to see, you need to receive that money on a monthly basis. If you receive it on any other frequency, after age 65, you'll still continue paying tax. So what would remain here would be 122,523, and then this would be subjected to tax. So the tax bands for people in retirement, that is from age 50, are bands of 33,333. On the first one, you'd pay 10% of this. So that tax would be, 10% multiplied by this. That would be, sorry, let me first finish the whole process. So the tax bands are normally 33,333 until 30%. So this would be 15%, 20%, and anything above this. Okay, I don't know what's happening here. Yeah, and anything above here would be 30%, anything above this. So this is already about 100,000. So anything above 100,000, you'd pay tax at 30. I mean, sorry, there would be 25% also. And then anything above that amount is what would be payable at 30%. So I'm sure we have mathematicians in this cell. I can see actuaries like Daniel Awondo. Would you please calculate for us what tax this would be? So this is 133. That means his highest tax bracket would actually be within 25%. Basically, people normally pay very little tax. When you look at the tax rate on the 147,000, it will probably be something less than 10%. So you pay much less when you're accessing your money as an income, because first there's a 25,000 tax-free amount. And then on top of that, the tax brackets are much wider than the income tax rates that we normally apply. So if we have a mathematician who's been able to do that, I'm not able to compute well using, because I've projected this screen, I don't know what's happening. So I hope that is clear, just to demonstrate what would happen. So this being a gentleman, this amount is slightly higher. If it was a lady, same age, this amount would be lower. Probably it will be around 140,000 or something like that. It's usually not significantly lower, but it is definitely lower than what a male would get for the same amount. Back to you, Regina.
Okay, thank you. I think I was a bit lost on the calculation. I'll need to get back to you on that so I can understand it end to end. One more question from Wanini. She asks, what's the difference between life insurance and annuity?
Life insurance and annuity are very different. First of all, if we just look at how they work. First of all, they have something in common. They are both life insurances. They are pegged on the life of the person who takes the insurance, but they work like in reverse. So when it comes to life insurance, you save in small bits, accumulating your money, then you receive it at a later date. While in annuities, you actually bring in a lump sum, which is now broken down into small amount in future. So it's like the reverse of the other. Life annuities is an accumulation asset. And then later, you mainly get the money in lump sums, either as partial maturities or one big maturity. While annuities, you bring in a lump sum and then you receive the income in small bits for the rest of your life or for a specified period of life. But they are both insurance contracts.
Thank you very much. There seem not to be any other questions. If anyone else wants a clarification, just feel free to get in touch with Rose. She's very friendly and will answer you. There are so many compliments to you, Rose. Thank you. Thank you for the insights. Thank you for a very wonderful presentation. The book is a gift and it was an eye-opener to Dave. Again, very informative. So thank you very much, Rose. We had a nice session today. So I'll bring the session to a close unless you have any final remarks. When you're done, Nova can pray for us.
Okay, first I want to thank you very much for taking your time and staying on until the end and participating. Our next webinar, our final for this year, will be looking at income drawdown. This is an alternative to an annuity. So for those who are saving through retirement benefit scheme, and you're in a pension scheme where you can only access a maximum of a third as a lump sum and the rest has to come in form of an income, you have two options. You either use an annuity or an income drawdown. So on 9th of December, we'll have our final webinar and we'll be discussing an income drawdown, which is a way of accessing your lump sum in small bits, but with no guarantees like in an annuity. So please mark your calendar and let's meet there. So I encourage those who have read the book, continue sharing your feedback, give your reviews. If you know somebody who would benefit from the book, consider buying for them as a gift. If you're wondering what you'll give people for Christmas, I have already given you an idea, and continue engaging us so that we can continue making these webinars better. I would also want to hear from you on what would you want us to discuss next year. I know we've only started discussing the products now. We've done annuity, we'll do income drawdown. I know we should do things like bonds amongst other things, but I would like to know what is it that you would want to hear so that we can prepare for you. We can prepare with you in mind. So once again, thank you very much. And thank you for your support and for being here throughout the year since we started these webinars. And I wish you all a good evening.
Thank you, Rose. Nova, you can pray for us.
All right. Yeah, thank you. Definitely very, very insightful. Let's pray. We thank you, Lord, this time for the time that we've had to be able to get through this session. We thank you for it being such an insightful and informative session. Thank you for all that we have been able to learn, all the knowledge that we've been able to acquire, even as Rose took us through it, oh Lord. I pray that you will help us, each and every one of us who was able to use this, to apply this in their lives, to be able to access greater finances, or greater financial freedom to this knowledge that you have passed down through Rose. And Lord, I pray that you will bless her even for this and continue guiding her as she continues to do this and as she continues to host these webinars, oh Lord. And I'm grateful for all who have been able to tune in. I pray that you will be with each and every person, even as we depart from here, in all that we are going to be doing, oh Lord, dear Father, that we will seek to glorify you in all that we do in our lives, in each and every aspect of it, including financially. I pray this, trusting and believing in Jesus' name.
Amen. Thank you all. Have a good night.
Thank you.
Thank you. Good night.
Thank you.